Hi, I'm Brian Duncan, local realtor here in Virginia Beach, and I wanted to bring you this real estate market update for the end of October 2022. We just have 2 months left to round out this year, and I wanted to bring you some statistics to look at to let you know what's going on with the housing market. So there's 4 things that I like to look at. The first one is sales prices, second, number of sales, and then days on market, and fourth thing, the inventory or month supply of inventory. So first, let's look at some charts that show the sales prices. So you'll see the week ending October 23rd a year ago, 2021, the median sales price was $364,000, and now that's up to $440,000, which is a 20.9% increase. Next, let's look at the number of sales. Over the last 5 years in Virginia Beach, we've ranged between 300 and 500 homes selling per month. Typically, the summertime is when it reaches over 500, and then the winter months dips below 300 a little bit. And then in 2020 and 2021, we saw record-breaking sales, peaked over 600 during the busy summer months. And then most recently in 2022, we didn't quite reach the 500 mark this past summer. Overall, sales are still within a normal range. Next, let's look at the days on market. For the week ending last year, October 23rd, 2021, the median days on market was 9 days. And then this year, with the week ending October 22nd, it was 16 days. So the time on market has trended up just a little bit, but it's still just between 1 and 2 weeks. It's still a very short period historically. Next, let's look at the month supply of inventory. The typical benchmark that we look for is if there's 6 months homes available for sale, then that's considered a normal market. If there's less than 6 months for sale, then that's considered a seller's market. If there's more than 6 months for sale, it's considered a buyer's market. And what that means, it shows us the direction of pricing and what the tendencies are in the marketplace. So let's take a look. You'll see going back to 2004 that the inventory was very low, it was less than 2 months. And then that started to increase as we got to 2007 and 8. That has a direct correlation to pricing. So we can look at all these stats, and it points that prices should be very stable, are most likely going to increase. And a lot of these statistics are based off sales from the last 6 months. And we've seen a change over the last couple months since interest rates have increased. And one reason for that is the Federal Reserve has stepped in and they've tried to control inflation. There have been reports that it's been as high as 8 or 9%, and their target goal is only 3%. So they have to get it under control, and they do that with a few different methods. One is they were buying mortgage-backed securities during the pandemic to try to keep the economy going. They were boosting the housing market and keeping rates low. Well, they've stopped buying those mortgage-backed securities, and they also control the federal funds rate. And that's going to affect the entire economy. It affects car loans. It affects home equity lines of credit. It affects credit cards. And so it also has an effect on the mortgage market indirectly. So they've stepped in, they've increased rates rapidly to try to get inflation under control. And this is a temporary measure. Once inflation is under control, then I think they're going to back off on those increases, and they may even decrease it at some point in the next 6, 12, or 18 months. So once they do that, then I think that the mortgage rates will probably come down. We also have to consider affordability. All right, with interest rates around 7%, or maybe slightly less than that for a VA or FHA loan, we have to look at that and compare that to the median household income. All right, so if we look at the median price house right now in Virginia Beach is about $400,000, and if we calculate the monthly payment based on 7% and include the taxes and the insurance, the payment's going to be about $3,000 a month. Then if we compare that to the median household income, which is about $80,000, divided by 12, it's about $6,600 a month. And typically people would use maybe 1/3 of that max towards a housing payment. So let's figure $2,200 a month max mortgage payment. So there's kind of a disparity there. $2,200 versus $3,000 is what's the actual cost right now. So that's mainly due to interest rates. When that comes down to about around 5%, our home prices are going to be sustainable at that point because it's in line with what the median household incomes are. The other point is, with inflation, I think the median household incomes are going to be higher. The statistic that I use of about 80,000, that's from 2021. So I think it's very different this year, and I think it'll be very different going into next year. So we have to consider that as we're kind of projecting numbers going into the spring and next summer. So I think even though rates are high, I still think the market is still going to be competitive for several reasons. Some people are going to understand that there may be opportunities down the road to refinance, and so when the right house comes along, they're going to take advantage of that, buy in the neighborhood or buy the house that they want, and then if rates drop down the road, they will refinance and enjoy the benefit of the lower rate. Or if it doesn't change, if rates stay where they are, if they even go higher, well, if you buy now, you're going to lock in that rate and enjoy that steady payment while the market goes even higher. But I don't think that's the case. Again, the Federal Reserve has stepped in and they've taken some temporary measures to try to slow down the economy, and I think that's going to loosen up hopefully in the next 6 to 12 months. So all these statistics point that we're still in a good market. Prices are still relatively stable, and they're going to be going up in the long term. Some people may think that they've gone up too high, or that prices might fall, or the market's going to tank. I just don't see that happening. If we compare this to the Great Recession, 2008 and 2009, the numbers are very different. For example, if we look at the number of foreclosures back then, it was as high as 20% of short sales and foreclosures, and so that was 1 out of every 5 homes. Currently, as of yesterday, there are 481 homes on the market in Virginia Beach, and only 7 were a foreclosure or short sale. So it's only 1.4%. So a very different picture there. Also, if we look at the amount of equity that people have, we have much more equity, and if people get into a bind, or if they lose their job and they need to sell their house, well, they're going to be able to because they have the equity and because there are currently a lot of buyers in the marketplace with very limited houses to choose from. So I don't think we're going to get in the same bind that we did back in the Great Recession. There are no statistics that point to that. So if you're a buyer and you're thinking about buying over the next 6 months, despite the higher interest rates that we've seen compared to the past, I think there's going to be an opportunity there. I think sellers might be more flexible. I think you're going to be competing with less buyers. So the odds of you having to write in escalation clauses or waiving inspections or waiving appraisals, I think we're going to see a lot less of that. So there's a great opportunity to get a fair price. And then I think that sellers may be more open to negotiation. They may be more open to paying closing costs. So that could be a good opportunity for you right now. And then if you're a seller and you want to step up and buy another house, there could be some opportunities in this market as well. Meaning, if you need to sell first in order to buy the next house, you might be able to use a contingency. In the last couple of years, that was very, very rare to be able to do that because you were competing with many buyers who didn't have a house to sell first. So I think now is going to be a good opportunity, but I think it's going to be limited as the interest rates come back down. Once they come back down to, let's say 5%, then I think there's going to be competition still. All right, there's a lot of buyers and there's going to be very limited listings. So there's opportunities for both. I think you need to look at statistics and make a good decision for yourself. And if you want to talk about this in more detail or any other cities in Hampton Roads, feel free to reach out to me. You can call, text, or email, and I'll be happy to go into this a little bit more detail and give you advice for your specific situation. All right, thanks for tuning in. I'm Brian Duncan, local realtor here in Virginia Beach. Have a great day.